I've got mentorship students on the line, and I've got Baltimore Shark Tank attendees on the line. And let me just talk a little bit about where we are with the deal and how this whole thing is going to transpire. Someone that I had spoken to said, geez, it would be really helpful if you had your money guy on the phone and we could hear you talk to him about how you would get this deal financed and what a borrower would really need to look like in order to make this deal happen. So that's why I've invited you. And for the record, everybody, if you want to write this down, his name is Eric Stewart, and his email is estewart at Atlantic Capital, Atlantic Finance. Oh, help me out here.
AtlanticBusinessCapital.com.
Yep, AtlanticBusinessCapital.com. And I've worked with Eric for years. He is the real deal. He can get the deal financed if the deal can be financed. If the deal cannot be financed, he will tell you in the first half hour and save you a whole heck of a lot of headache. And just to give you an example, we were working with one of my clients years ago who had this deal in Oklahoma City, and this guy wanted this deal so badly, and I brought him to Eric. I think, Eric, you were the second person that he worked with. The first guy couldn't pull the trigger, couldn't make the deal happen because the deal, it was not financeable. But he led the guy, my client, down the primrose path. I said, listen, let's talk to Eric, and whatever Eric says goes. And you took a look at the deal and said, nah, this deal's not going to work. And my client didn't want to hear it, and he went to 4 other finance companies, and everyone promised him the world, and nobody delivered. And fortunately, you know, what my role in that whole issue was to make sure that my client's earnest money never went hard. And for 6 months, his earnest money did not go hard, which is absolutely shocking to me. But in the end, he got his earnest money back, but he wasted 6 months of time. Had he just listened to what Eric said early on, it would have saved everybody a whole lot of time and aggravation. So that's one of the reasons why I really like working with Eric, because you're just going to know right away whether the deal is going to happen or not. And you know, it's not like Eric. You know, you'll get these guys. You'll find them on LinkedIn. You'll find them on Big Deals or BigPockets.com. You know, oh, I can get you 90% LTV, all this other stuff. Listen, Eric will tell you the real deal. He'll tell you exactly what the program is, whether the program is viable for your property or not. And if Eric says it isn't, then that just doesn't work out. So that's why I work with Eric. Now, so we've got these 2 groups. We've got my mentorship students on the line. We've got the Baltimore Shark Tank attendees on the line. And let me explain to you what happened here, Eric. We negotiated a deal with a client of mine in the Shark Tank. It was a nice cream puff of a 36-unit apartment complex in Charlotte, North Carolina. My client's owned it for about 3 or 4 years. He bought it from the city of Charlotte. It is a HAP product, HAP property. It is $1.25 million is what we negotiated it. We negotiated a $100,000 seller carryback, and I stressed that we didn't put it in the form of a second mortgage, so we can be very creative with how this seller financing is going to go. It is 100% occupied. It has a waiting list. It has a 3% rental increases guaranteed every year. The Housing Authority pays the utilities as well. So I sent you over the link to the Dropbox. I don't know if you had an opportunity to go through some of the documents, but just today, I drafted yesterday the purchase and sale agreement when I was on a plane, and just today I submitted the purchase and sale agreement to Bob, and so Bob's going to obviously tweak it and come back, and we'll have this puppy under contract and looking to go. So the issues here, as I kind of mentioned in one of our last calls, is one of the issues is we're not going to have to put down 20%. We're not going to have to put down 30%. We're not going to have to put down 20%. If we do a 20-25% LTV or 75 to 80% LTV loan with that seller carryback, our skin in the game is going to be less than 20%. I know that may cause an issue with some lenders, so I want to talk to you about that as well. The other issue that we had raised before was the fact that we're really looking probably for about $1 million, maybe just under $1 million of loan. And the issue becomes one of recourse and non-recourse. And I would like you to discuss with us today a program that I am not at all familiar with, and you can bring me up to speed, and that's the Fannie Mae small cap product, which I know nothing about. And then if you can kind of give us a picture as to what will a buyer need to look like to qualify for this deal. And that is really what we want to get a handle on, because as I said to people before, and now the thing is, and I want to stress this to everybody, Dobbins Law is the one that has this contract under agreement. But as I said before, if somebody on the call finds a wholesale buyer, I will split a wholesale fee with them. So anybody on the call can make money on this deal. Someone had said in an offline, in another conversation, that they thought that I had implied that anybody that's on this call, if there's any money to be made, we're all going to share in this deal together. And I wanted to clarify that very, very quickly. If you don't work, you don't get paid. So don't think that just by being on these calls, if somebody brings a wholesale buyer to the table, they're going to get the same amount of compensation as you would for doing absolutely nothing. So this deal is open for anybody on the call to make money on. They can buy it themselves. They can wholesale it with me. They can put together the syndication deal, make the thing happen. You know, once you see the numbers and you listen to what Eric has to say and you think you can pull the trigger on this thing, hey, have at it. Absolutely, have at it. But if you're not doing anything, don't think for a second that you deserve any form of compensation. I'm doing a webinar on Monday night with attorney Jeff Lerman where we talk about partnerships. I think that the title that I named it was the biggest mistake I ever made in my multifamily investing career, and it's all about partners. And the problems that I had was that I had partners in deals who did absolutely nothing. And they wanted to get paid. They ended up getting paid as much as I did. And I swore I would never let that happen again. So never let yourself into a partnership where people can get paid for doing absolutely nothing. Okay, so I have just been talking on, and of course these GoToWebinar things, you always wonder whether people are actually hearing you. So Eric,
yeah,
are you there?
I'm right. Yep, I'm
okay,
right here, Charlie.
Hold on. We got some questions. Yeah, so if anybody has any questions. Okay, Kim, it's Stewart, S-T-E-W-A-R-T. Not the old English way. I think the Scottish way is the way to do it. So, yeah, so if anybody has any questions, I've got the question screen up here on the block. So definitely just jump on in and ask your question. You are welcome, Kim. Okay, so, all right, Eric, let's talk about this deal in light of the questions that I just brought up.
Yeah, absolutely. First, I want to say thank you, Charlie, for bringing me in where I can just be on a call and make some money. I think that's great.
Yeah.
What a great program you have.
Yeah.
Instructions on an hourly
Oh my
basis.
gosh. Do I have to put everything in writing for you, Eric? Do I have to put everything in writing?
I think you are great. Your program is wonderful.
Thanks a lot.
No, but seriously, yeah. After the introduction, I think it's there are some specific nuances to the transaction that you talked about that we should really address. But first, let's talk about Fannie Mae's programs in general, how the small balance program is defined, what the boundaries and parameters are, and also talk about borrower characteristics within the small balance program. First and foremost, starting from a very macro viewpoint, Fannie Mae's multifamily program has performed exceptionally well, and everybody on the call is probably a multifamily investor, and you should take pride in the fact that your industry and your area of focus has been a shining star for Fannie Mae. It hasn't performed like their residential side has. You're looking at very, very low default rates, so that's something I think we should all be proud of because of our association with the multifamily industry, first. Second, Fannie Mae, they section their multifamily division into different loan sizes. They've got their general program for anywhere from $5 million and larger loans. It's called the Delegated Underwriting and Servicing Program. And what they've done, they have delegated or approved.
Hold on, let me stop you right there, Eric, and just say something that I want everybody to pick up on what he just said and listen very carefully as to how he's going to describe this, because when you're in the industry, there are certain acronyms you have to understand. The one that Eric just mentioned is what we call the DUS lenders, the DUS, Delegated Underwriting and Servicers. So when you hear somebody say, oh, I'm a DUS lender, Eric is about to describe exactly what that means. So commit this to memory so that when you hear this terminology, being in the business, you will know exactly what they're talking about.
That's a great point. Yeah, being able to do that is extremely important. That's a great point, Charlie. So what Fannie did was they've approved or delegated about 25 different institutions to essentially go out and underwrite these loans and actually fund them. I mean, wire the funds, and then within about a month from closing, they will sell that loan, package it up, and sell that loan to Fannie Mae or a like investor. They have the option to go out and do a like investor, but for the sake of this call, they sell it to Fannie within 30 days after it closes. So they've been given the authority to, they've been delegated the authority to underwrite and service these loans. So they are considered a DUS lender. The DUS program is, again, for anywhere from $5 million and up. Below $5 million, and in major MSAs it can go down to $3 million, they have what's called the small balance program. Small balance program it's an expedited underwriting. It takes almost as long, but it's not quite as heavy. The due diligence is not quite as heavy on the legal side, and they have more cut and dry property underwriting characteristics. Essentially, they make less exceptions, and there's not as much wiggle room on the property performance and on the borrower characteristics, which we'll talk about in a minute.
Okay, but, Eric, let me just interrupt you there. You said that this is available in certain MSAs. Are they the smaller MSAs have access to this, or the larger MSAs? What's the ruling there?
You can get this done in all of your markets. The small balance deals are available nationwide, but they typically cap it at $3 million in smaller markets, and they'll go up to $5 million in your major MSAs like New York and Chicago, LA. Larger cities, they'll do larger deals under the small balance program. So that's why I say most MSAs. So
okay.
It's important to note, though, that the exceptions, you don't see the same kind of exceptions that you would on a DUS deal on the small balance deal. And this is because they're by nature, they don't want to touch the file as much. They put this together so that your cookie cutter deals fit into the box, they flow through the system, and they don't have to touch the file as many times. And here's some of the characteristics that you're going to see that are you really don't see much wiggle room on the small balance program. One is your occupancy levels, 90% for 90 days. If you have you're trailing 3 months prior to closing, you need to be north of 90%. If you're not, then there's a ripple in the water, and it's not going to go in the small balance program.
Huh.
A lot of time, and when you look at your occupancy, or let's flip to the reverse side, look at your vacancy. It's important to note economic vacancy or economic occupancy relative to physical occupancy. You can have 90% of the people in the units, but you need to have 90% of the people paying their rent, and that's very important. So keep in mind,
all right, so that is 90% for 90. 90 for 90 gets us into the Fannie Mae small cap program. But you have other programs that will get down to a lower occupancy level, correct?
We do. We've got alternative lenders that can handle, we'll call it Fannie Mae fallout for various reasons. If it doesn't qualify for Fannie Mae, and just some reasons you see, let's say the occupancy is not trending in the right direction. Let's say the dollar amount is too low. Let's say property condition is not what it needs to be. There's a number of reasons why a loan wouldn't qualify. Because, again, Fannie Mae is really the top tier or the most attractive financing out there for multifamily. There's a number of reasons why it wouldn't close, and we have alternative lenders that we can go to in those situations.
Okay.
But the small balance program, again, is they need to see 90% for 90 days. They need to see you cover your debt service at a 1.25 ratio, meaning if your monthly payment is $10,000 a month, you need to show a net operating income of $12,500 a month.
Right.
And that's very important. They from a borrower standpoint, there's not as many exceptions. There's not as much wiggle room in this area. They need to see your net worth greater than the loan amount that you're looking for. And there's a couple areas to pay attention to there. Is if the bulk of your net worth is made up of, and I'm just pulling an example out of the air, but if the bulk of your net worth is made up of a company that you own, let's say it's a law firm, and you value that law firm at $1.2 million, they very well may not recognize that the value of that business. It's not something they could easily realize because that goes with you wherever you go. If the bulk of your net worth is in commercial real estate, that's something they can understand. They can get their head around the valuation of it, and they will recognize that. But keep that in mind. If you've got a plumbing company, and a lot of investors do fall into this category when we're working in the $1 to $5 million range. If the bulk of your net worth is in your plumbing company and possibly an antique car collection or a country club membership, those items don't get recognized in your net worth. So keep that in mind. There's also a liquidity requirement. Now, on paper, you need to show post-closing liquidity, cash or cash equivalents of at least a year's worth of mortgage payments, 12 months worth of debt service. That's on paper. The reality is you want to come into the deal with greater than 10% of the requested loan amount. You don't want to come in at the minimum, or you risk that deal not getting done, because shooting for the minimums is not what you look for. You want to show an attractive deal to your lender, and an attractive deal is at least 10% of the requested loan amount. So in this scenario, $100,000 sitting in cash or cash equivalents in an individual bank account or investment account, not IRA money. Okay. Did you want to clarify that a little more?
Yeah. Let's talk about that for a second, because right now you've touched upon two things that scare the daylights out of any new investor, and that is the net worth issue and the liquidity issue. So what you're saying is, in this and let's tie everything. And I know that this product, this property, would not comply with the small balance Fannie Mae, but let's use the small balance Fannie Mae requirements as applied to this particular property. So what you're saying here is, if we were to take this deal to Fannie Mae, the sponsor of the deal or someone in the deal would have to show a net worth of $1 million. And that then somebody, an individual, or could it be the entity purchasing the property, could they show an equity, a cash balance of $100,000? Who has to own that requirement?
The individual that is signing on behalf of the company is considered and this is the terminology, is a key principal, and they are the key principal in the transaction is defined by anyone that owns greater than 20% of the deal. So let's say if you are syndicating a deal, and you get greater than 20% ownership, even though you may be a member of the transaction, that typically will trigger they'll trigger you as a key principal. The second characteristic is if you are a manager or some type of officer, decision-making person of that corporation, you're a key principal. You're going to get underwritten for the loan. They're going to pull your credit. They're going to look at your net worth, look at your liquidity, and you're going to have to sign on the loan docs. This is a non-recourse loan with the carve-outs, and you are going to be the one to sign on the carve-out, or one of the individuals to sign on the carve-out. The characteristics that I'm giving you, $1 million net worth or net worth equal to the loan amount, so on and so forth, that is cumulative of your key principal team. That's everybody added up.
Oh, really?
It's not that as though each individual has to come in with $1 million. I will say this: it's not looked upon favorably to piece it together and bring 4 people in that are worth $250,000 just to get your $1 million loan amount. That's going to be considered a weak deal. They usually want to see just a few people in there that look solid, that are bringing the bulk of the qualifications. That's just real-world application relative to what's on paper, because there's a human element to this. Your deal is stacked up on the underwriter's desk with a lot of other deals, and you need to show an attractive deal. Those are the ones that get done. So, okay,
so it can be so you put together your sponsorship team. You're going to need to have, hopefully in one fell swoop, a few of you. I mean, if we're dealing a $5 million property, then yeah, having 2 or 3 people is going to still be a strong deal. So, but collectively, your sponsorship team needs to have a net worth equal to the principal amount, and then also, can all of them, their liquidity together, get added together to come up with that 10%?
Yes, it can. They look at liquidity that way as well.
Okay, now let's talk about the credit issue. How does that work?
For the small balance program, we need to show a middle score of 680. And that's obviously they pull all 3 credit bureaus. And your middle score needs to be greater than 680. The question then comes up with multiple people on your key principal team. What if one person drags it down? They will average the scores out and look for a 680. They will also look at that one individual and what value he brings to the overall team. If the bulk of your net worth and experience comes from that one individual, that's going to be taken into consideration, and that could be a red flag. If he's just coming in because he's trying to build a relationship with Fannie and get this deal on his portfolio, then you may want to consider cleaning up your credit and jumping on the next one, because it could be problematic. So.
And let me just say here on this call, if anybody has any credit issues or is concerned about their credit, I have a webinar that I have done with an attorney out of Cincinnati, CreditImprovers.com, I think is his company, Ed Garrett. The guy will get your score up 100 points within 30 days. And the guy's an attorney. It's all legitimate. What he does is unbelievable. He does a fantastic job, and it's all by the book. And if anybody wants me to send them the link to that video, I will do that. Just as a matter of fact, what I'll try to do right now is while I'm on the phone here with Eric, I'll try to jump online and see if I can get the link and post it here in the board so you guys can listen to the webinar. If you're thinking about, if you need to clean up your credit, this is the guy you want to talk to. And he charges like $300. It's unbelievable. So it's really a great deal.
Yeah, that's valuable. That is valuable. When I said earlier that a lot of, you don't get the same exceptions on the small balance program. On the DUS program, the larger deals, that credit threshold is 620. not 680, it's 620. And if somebody comes in below that, we can put a letter of explanation together, and they do look at the body of the credit, and we talk it through. Small balance deals is pretty much a scoring system and moving through. So you don't see the same exceptions.
Okay.
You know, and the third one is that the third characteristic that they look for a borrower is they want to see that you've got some level of experience around there. That experience requirement is going to vary from lender to lender. You've got lenders that are hard and fast that you need to have ownership in that market for 2 previous years, and they really don't deviate from that. You've got other lenders that will, if the rest of the deal looks pretty good, if you're well capitalized, it's a stabilized property, which it's going to be, and you know, maybe you can show that you've proven you've got absentee ownership in other markets. Absentee ownership is clearly when you don't live in the same market that your property's in, but you've successfully managed it. You know, you can leverage that. It's a transferable skill, so you just choose another market. We can leverage that if everything else is looking very good. So that's we've done that quite often. Don't get too taken aback by the experience requirements, because it's kind of a gray area with a lot of lenders.
All right, in the chat box, I just put up that web page. So if anybody wants to click on that and take them there, you know, have at it. It's really a great video. People raved over that video. So yeah, definitely check that out. Okay, now let me just, as far as your team goes, if you have one person on your team that meets the management requirements, you're all set, right?
Yes.
Okay, so essentially, you know, Eric, when you and I first started working together, I got it. I totally understood. What you need to do here is, just like I say in all my seminars, this is a hoop jumping business. Eric has just laid down a bunch of hoops, and you've got to figure out, put the pieces together to make sure that you are able to jump through all of those hoops and get the deal done. And that's putting together a sponsorship team that Eric likes and says he can get the deal done, you know, all of that type of stuff. And let me just add to that, so you all understand this. Eric works for you, so he is going to help you put that together. He's going to, right from the time he gets the file, he's going to start packaging that property up so that it can get financed. That's how he makes his money. So he is, you know, that's why you get a deal, you know, you're making an offer on it, you really want to do it, call Eric immediately, and he can help you start to put the deals together.
Yeah, it's great to get involved before the LOI process, or at least once the LOI is accepted prior to the purchase contract. That way we can kind of go over some of the nuances of your finance contingencies and your timeline.
Right. Right.
So where are we? We're talking about borrower characteristics at this point, I think, and that's pretty much the bulk of it. What you're looking for a small balance program from a borrower characteristic standpoint. And we've covered the parameters of the small balance loan characteristics and what it looks like. Aside from your amortization and your term options, you know, Fannie's loans are going to be 30-year amortizations. You're going to have your choice of fixed periods and terms. Most are choosing the 7 or the 10-year term right now. If you did want to hedge against rising or anticipation of rising interest rates later down the road, you've got longer-term options, anywhere from 12, 20. You can even do a 30-year fully amortized loan. But most are still choosing the 10-year. Some are choosing the 7-year. One of the things that it's important to note about your term, and this is interesting. Fannie Mae looks for the 1.25 debt service coverage ratio, and they utilize their own underwriting floor for the interest rate, because your interest rate's going to vary until you lock it a couple days before closing. For a 10-year term, they use 5.25. Now, Your actual rate's probably going to be somewhere around 5% on a 10-year right now. But again, it fluctuates with the Treasury. But they use as their floor 5.25 if it's a 10-year term. If it's a 7-year term, that underwrite or that interest rate floor jumps up to 5.75. They raise that floor. Your actual interest rate is probably going to be somewhere around 4.3 or 4.5, but they use a 5.75% interest rate. That's because your time in the deal before you have to refinance is shorter. And they want to make sure that you're going to be able to refi out and not have a valuation issue upon your exit. So this is one of their exit tests that they do. So you want to utilize that when you go in. If you're planning on going with a Fannie deal, make sure it's going to service at 5 3/4 on a 7-year. Otherwise, you're not going to have your debt service. You're going to burn up a lot of time.
Okay, so this is kind of interesting. This is new to me. I've never heard this before. So what you're saying is that Fannie may learn their lesson from the 2008 debacle with all these CMBS notes and the drop in the rise in cap rates and the drop in the valuations, and now they're saying, hey, we want to protect ourselves today from that ever happening again in 7 years, which it definitely could. So we're going to stress this deal a lot stronger if it's a shorter-term deal. If it's a longer-term deal, it's going to have an additional 3 years to build back up its valuation, and we think we're going to be a little bit safer. Is that kind of the right characterization?
That's absolutely it. You nailed it.
Wow, that's really interesting. Is that new to you? I mean, have they been doing that for years, or?
Yeah, they've been doing it for some time.
Interesting.
They were the multifamily, from 07, 08 and on. They were really the rock. I mean, Fannie supported the debt market for multifamily the whole time, and we're seeing a lot more conduit activity right now. They're coming back into the marketplace. Fannie's kind of scaling back, which is great. That's the way it's supposed to be. But yes, they implement these exit tests just to try and guard themselves, put a better loan quality out there for their investors. It's just like a lot of you folks are raising money for your equity side. Remember, your debt side is funded by investors as well. There's people that are buying these notes. I mean, Fannie is obviously buying a lot of it, but there's investors that are out there. The terminology is they're chasing yield right now, and they see the multifamily market has such a strong foothold and doing well. They're jumping in, and the conduits are really coming out there. But that's a different call. That's for this type of this balance deals. You don't see a lot of conduit activity. That's $5 million or more.
Okay. All right. Let me just throw this out here to everybody. If you have a question, you can fill in the question box. If you have if you need to raise your hand, you've got the spot where you can raise your hand, and I can call on you, and even I can unmute you, and Eric, you can ask Eric the question directly. But what I'd like to do now, Eric, is I'd like you to start talking about this particular deal. How do we make this deal happen? What's going to happen? I'm going to get this deal into contract in the next couple of days, and then once I do that, I'm going to get all the due diligence information. We're going to start to put the whole thing together, and at the same time, I may be, putting it together to market out to wholesale the contract or something like that. But once I get that deal into contract, I'm coming to you with the deal, and I don't know who the buyer group is yet. I haven't put the thing together, but what do I start to do with you?
All right. First, let's look at. Let's just start from the outside in. Charlotte is a full leverage market. All right, you can go up to 80% loan to value.
Okay, who's the lender we're talking about here?
I'm looking at Fannie Mae still.
Okay.
I'm still looking at Fannie. There are certain small balance lenders out there that will go down to $750,000. They don't really publicize that. They're not looking to market to below $1 million. But it's kind of a relationship thing where we for an attractive deal, they don't have to touch much. We might be able to get it done down to $750,000. This one, it's because of there's characteristics that we're going to dig into in the deal, but I wanted to start with Charlotte and the market that it's in, because that's what you're going to look at first. If you're in Atlanta and you want to go Fannie, you're not getting more than 65%.
Hey, listen, let me interrupt you for a second, because Ted's got a very interesting question. This is a good question. Let me read this to you, and I want you to answer this one. Ted asks, is the 10% of the loan amount a liquidity requirement, or is that a skin in the game requirement? I.e., the your down payment or equity contributed by the sponsors requirement.
It's a liquidity requirement.
So it's over and above. I got to come to the table on this particular deal. I got to show up 80% LTV. I got to show up with about $250,000. I put the $250,000 down, and I still have to show $100,000 of cash in a bank account.
Yes, you're gonna. This is a post-closing. This is money that's left over after the deal closes.
Okay, so this isn't like I can just show them that I've got my investors' money sitting in a bank account. Here's my liquidity. They want to see what's going to happen after closing.
That's correct. They want to know that there's going to be some type of cushion there, that's somebody has a vested interest in the success of the deal, has the ability to crutch it along if there's some unexpected occurrences. Okay.
All right. So for some people out there, you can get yourself into a deal and help somebody close on a deal just by having 10% liquidity for the deal in the fund. Just sign your name on the dotted line, so to speak, and that you'll be able to check that box off one of the hoops you have to jump through. So I don't recommend it, but that's if you have to piece the deals together based upon what the underwriting requirements are, that's one way to do it. It's going to cost you, but you'll get the deal done. So I'm sure you love hearing that, Eric.
That liquidity requirement is not escrowed. It's not reserved. It's not a maintenance thing. That's they don't periodically check your bank statements to make sure you've got that liquidity in there. It's just at the time of closing.
One of the people in the deal has to show a 10% liquidity, a snapshot in time.
That's correct.
Okay.
Usually I like to do it within 60 days of closing or 30 days of closing. So make sure it's, so.
Cool. Okay. All right. So, so go ahead and let's talk about Charlotte. You like Charlotte, full leverage deal, 80% LTV.
Full leverage, 80% LTV. So you're looking at $1 million on paper. Just we haven't got deep into the deal yet. You're still looking at $1 million loan, so you're okay there. The characteristic, you said we've got 100% occupancy. So as long as we've had that trending well for the last 3 months, we're going to be in good shape there. With this deal, the important characteristic, and what we're probably going to spend a lot of time talking about, is the HAP characteristic.
Right.
Because that's where it doesn't exactly have a nice square peg for a square hole. Then the first question you have to ask is the contract tenant-based, or is it a project-based HAP contract?
Okay, this one's project-based.
Okay, great, good. If it's project-based, it's most likely annually renewable.
Yes.
And annually renewable HAP contracts are going to require what's called a restabilization reserve.
Okay.
They were doing, they were doing contracts a long time ago that were like, 40-year contracts, and they were good for that long, 30 or 40 years. Most of those have expired, I believe, and they've almost all converted to annually renewable. And you might not have it next year. So if you don't, Fannie wants to make sure that there's money in the till to make your payments while you restabilize the property.
Right.
So that means at closing, they're going to collect anywhere from 6 months to a year's worth of payments and hold it.
Okay.
That's it. And I know there's a lot of opportunistic investors, which I totally respect. No, you don't earn interest on the money. I always get the question, well, can I earn some interest on that? No.
Okay, now hold on a second here. This is going to be the lender's requirement, right?
Yes.
Which means that this money is going to have to be added to what's needed at the closing table.
That is correct.
So I've got to make sure that when I go to raise my private money, I include this additional cost in the deal.
That is correct.
Okay. All right, let me just kind of speak out loud here and tell all these great mentoring students and other people on the phone call that I think I might have blown something here. I think I probably should have negotiated the deal a little bit differently with Bob. And this is something that you see happen with assumption deals. Assumptions work similarly. Whenever you are assuming, well, what happens is you build up a reserve replacement on most mortgages. What Eric is talking about here is a reserve replacement just for the rent, right?
That is correct. It's called the restabilization reserve.
Okay, so
with that, anywhere from 30,000 to 66,000.
Okay, so what that means is that what I should have done is I should have said to Bob, hey Bob, whatever you have in that fund, I want you to carry over to the new owner. So that way I don't have to come up with more money out of my pocket. The money stays with the property and I get the benefit of it. Now Bob may have balked at that, as I would, but because I think what you're saying, what happens at closing here, Eric, is when we close, whatever's in that restabilization fund today, Bob is going to get. And then the bank is going to say, okay, Mr. Dobbins, step on up, your turn, fill the bank again. And I'm going to have to come in with my own new money.
That's correct. That would, yeah, it's not standard that any kind of escrow like that would convey, because it is a lender requirement. When you retire that debt that's on it now, those escrows are going to be refunded back to the seller. So.
Right. Now, here's the problem, and I want everybody to understand this. What we're talking about here is a new money purchase. What the other alternative, not in this case, but when you see this happen, is on an assumption. An assumption is a similar situation where instead of having this rental reserve, they have the reserve replacement, the money that should be used for the benefit of the property for capital expenditures. Now, what some owners do is they bank up that money. They never use it. They never put a dime back into the property. So when they go to sell that property or have it assumed by somebody, they get that money in a check right back to them. And what the bank does is at the closing, they take that money and they write a check out to the seller, and then they turn around and they turn to you, the buyer, and they say, okay, we just paid him $100, we want $100 from you, because the property has to have that $100 in its bank. That is money that needs to be used for the benefit of the collateral. And what that means is that now you've just had to increase the money you need to raise to get into this deal by $100,000. Now, the solution to that is when you make the offer on an assumption, you say anything in reserve either comes to us at the closing or the seller has to spend it all on the property. And that way you end up with money spent on the property, plowed back into the property, the capital, the collateral is getting the money it needs, and it's coming out of the seller's hide, and you don't have to show up to the closing table with $100,000 more money. So that is something that you need to think about whenever you're making offers on assumptions, or in this particular case, this rental reserve requirement. Always think about that whenever the lender is putting these types of requirements on the property. Okay, carry on, Eric.
Well, that's one of the key characteristics is that HAP contract. Also, that HAP contract is going to require that you as a borrower have a minimum of 2 years HAP experience. And also, and they're pretty hard on that. And your management company needs to show 3 to 4 years HAP contract experience. Okay,
we're all set with the management company, because the existing management company is going to keep doing it for us. So we got that box checked. We've jumped through that hoop. Now let's talk a little bit about the existing or 2 years of experience, and you say that's hard and fast. Well, my question is, when Bob was getting into it, I don't think he had 2 years of HAP experience. So I wonder how he did it. What ways are there around this requirement?
Well, it's a different world right now as well. So, I mean, things were, I don't know, when did he purchase it?
Oh, I'd say about 4 years ago.
He's 4 years into it. So he's 4 years into a Fannie Mae loan?
I don't know if it's Fannie Mae. I think it's a local lender.
Oh, that's different. Yeah, that's different altogether then. I mean, this is a Fannie Mae requirement. It's a Fannie requirement. If it's a local lender, then they've got a recourse loan with him, and he puts a personal guarantee on it. That changes the whole conversation. Okay,
so you think on a deal this size, we could still be looking at Fannie Mae on a non-recourse basis?
Absolutely. Absolutely. The program that we're doing is non-recourse.
Okay, all right. So that's a good thing. Now let me throw this little wrinkle in here. I negotiated with Bob finger quotations, a seller second. All right. Now we do not call it a seller second. Is actually the way I've drafted it, and you can see it in this purchase and sale agreement that I put in the Dropbox. Is we put him into the deal as a essentially a Class C member of the LLC that has a membership interest that essentially acts like a second mortgage. So I guess my question to you would be, hey, if we can bring Bob in this way, and he technically remains a part of the ownership entity, and he's got 4 years of HAP experience, is that going to solve that hoop? Have we just jumped through that particular hoop?
Is he going to sign on the loan docs?
Okay, so you're saying that does he need to?
Yeah, he would have to sign on the loan docs.
Okay.
And be a key principal in the deal.
Okay.
And if he's going to do that, then let's get really creative and call it a refinance.
And what would that mean to
cash out?
And what would that mean to Oliver? That means less money down?
You don't bring any money to the table, and you do it as a cash out refi.
Wait a minute. Are you trying to tell me that I can buy multifamily property with no money down?
Step right up, Charlie.
Yeah.
I'm just saying, if he's going to stay in the deal, and he's a key principal, you're just buying into the partnership at that point. You're buying into the corporation at that point. If he's guaranteeing it, let him refinance the deal, and just do it as a refi based on market value, and use that money to buy into the corporation.
Okay, we haven't worked out the numbers yet. Because Bob is obviously going to want all his money in his pocket as best he can. So I don't know if that would necessarily work yet, but that's a very cool concept. I'd like everybody on the call to think about that. That, if you're doing something like this, another alternative might be if you've got a good relationship with the seller, you might be able to swing a refi, which changes everything, which solves a lot of these hoops that you have to jump through. So, just keep that in mind. Okay, that's a very interesting thing, Eric, and I'm going to have to think a little bit more about that. But right now, let's consider this as a new money deal.
Okay. All right. If he's staying in the deal, then yes, that really does help out a lot.
Okay.
But he's going to have to be a key principal in the transaction.
Okay. All right. All right. So I don't know. I would have to put that all down in writing, all the pros and the cons of that, and figure out whether that's a viable alternative. And then I'd go pitch it to Bob and say, Bob, this is, we're coming up with problems on this. What would you say if we structured it this way? So that's something that we might want to think about. And my answer, my first response is, well, if he wants to refi, what does he need us for?
I'm sorry. Your first response is what?
If the solution is to refi this thing, why? We look at Bob, and Bob says, well, what do I need you for anyway? I can refinance it myself.
Well, true, but he obviously has some interest in stepping back from the operations, or at least bringing in some support from the operations.
Well, I'll tell you.
Anyway.
The fact is, this property is a cream puff, and it doesn't take him all that much to manage it. So
why is he selling? Just to realize the cash.
He's been buying a lot bigger properties. Time for him to move on. He said 36 units is getting to be too small for him. He's just buying bigger stuff. And I think he might have had a liquidity, issue when he was buying some other properties. So we'd like to have that cash available to him. So,
right.
all right, let's keep it moving here. Yeah, let's keep it moving so we can figure out exactly what we, what the next steps are with you. So,
basically, what things are shaping up to be is you're going to end up. We've kind of decided you're probably not going to go Fannie because of all the hoops and the restabilization reserves and such. Those are the parameters that I alluded to, because we kind of said at the beginning of the call we're going to focus on a Fannie loan for the purpose of the call. What would end up happening here is a recourse loan with one of the regional lenders, like a bank like TD Bank or BB&T, somebody like that. That's who would step in and probably be the best the best price point. Their terms really do vary, but overall, you're probably going to see an amortization of 20 to 25 years. You're going to see a loan-to-value. They might go 80. They're going to want to keep you at 75, but they very well may go 80. Your loan term is going to be between 5 and 7 years. And your interest rate is probably going to be roughly around 5%. They typically do not collect for replacement reserves, but they will escrow for taxes and insurance.
all right, let me just say right now that I'm not, at this point in the discussion, disinclined to look at a Fannie Mae. I think, as what I mentioned on the phone call early on, an earlier phone call, was the fact that one of the issues with this deal is the fact that the size of it would require a borrower to sign on the dotted line as a non-recourse loan, which would scare a lot of people away. If Fannie Mae is still out there, that non-recourse is huge, and if the issue is one of putting together a team, I think we can do that. I think we can look good on paper for Fannie Mae. So that's after listening to what you have to say, I'm not sure whether a Fannie Mae or a local lender is going to be the right choice. I just can't tell right now.
Well, and that's going to be part of our due diligence.
Right.
The way the contract is structured, while you're doing your due diligence, because one of the things that everybody should note, and something you did that you did very well, Charlie, is your finance contingency is at 80%. So you've got to get out of Dodge clause if you can't get the creme de la creme of the loan, of a loan. A lot of times you can make a 75% LTV work, but you've got that option because if you don't get 80%, you don't have to buy the deal.
Right.
If you'd have put 70% in there, then and try to get 80, you'd be in trouble. So while you're doing your due diligence, we'll work on the loan side, and then you can, once you have some LTV options or you've got some LOI options from a lender, then you can make your decision.
And let me just, another acronym, LOI here, folks. On my side, on our side, it's a letter of intent. On Eric's side, an LOI means what, Eric?
Same thing, really. Letter of interest.
Letter of interest is what you guys call it. So, yeah, and how binding is a lender's LOI?
It's not at all. There's no teeth to it. It's strictly relationship saying, this is what we see coming in, this is what we expect the loan to look like, but it is subject to everything. So when you see a rate when you see an interest rate on your LOI, remember it's wide open. Don't judge it just on interest rate, because that will most likely change between LOI and closing.
Okay. All right. Now, I guess the next thing I need to do is really just get the contract signed. He's going to send me over the due diligence information. I'll start putting it all together. I'm also going to just share it. Do I share it with you in its raw form, or do you want it in some particular package?
No, the raw form is better. That way we can look at true actuals and see what they're really throwing off.
Okay. All right. So I'll get you, once that comes in, I'll shoot that right on over you, and then we'll just keep talking and figuring out what's the best way to get this thing put together. So if anybody, let me open it up to questions here. If anybody has any questions, just raise your hand. I'm looking at the screen now, so I'll watch for a hand being raised. But if anybody, can think of something that might squirrel this deal, you, just by the look of it, Eric, what do you think as far as the quality of the asset, and can you get a deal like this financed?
Yes, we absolutely can. And the important thing to note, and you said it earlier, you mentioned something about being able to get deals done. There is financing for every deal. There is a loan for every deal. The art of the deal is finding the financing that's going to work at a price point that gives your investors their return. And usually that's why deals don't happen I can get you a loan. We just make sure that loan fits into your guidelines so that you can give your returns to your investors and you don't price it out. So that's going to be the important thing, is if we end up at BB&T with a 25-year amortization, is that still going to work for you? Or do we need a 30-year AM so your debt service is low enough so your net cash is there? And that's essentially what we need to focus on.
Yeah, and the issue is that, and this is where we the software that we use really spells it out there, is the internal rate of return. If you're dealing with a shorter amortization period, that just means you're paying down the mortgage faster. That means that you're not going to get as much of a cash flow out of the deal on a regular basis. But at the end of the day, you put more money into the property, and you're going to be getting it out when you close. So it's not so much on an annual cash flow basis, but on an overall long-term hold of the program. That's when it's going to really start to show its worth. So, I've got a property that's 20-year amortization, and yeah, the cash flow on it is not that strong, but I know that I'm just paying down that mortgage that much faster, and that's okay with me. So, that's something, that kind of conversation you want to have with your investors as well. Are they looking for current cash flow, or are they looking for capital appreciation?
And depending on, and you know the equity side better than I do, Charlie, but depending on where you're raising your capital from, you may need to go non-recourse. I believe some self-directed IRA money, that they mandate that it's non-recourse debt, correct?
I don't know.
I really think there's a caveat in there with when you deal with self-directed IRAs, it has to be non-recourse debt.
Well, that's interesting, because I've got a deal where it's a recourse loan and we have IRA money in the deal. And I don't remember that ever coming up. That was but we did that, back in 2007. I don't know if that's still around. That's still an issue, or was an issue then.
Yeah, I focus on the debt more than I do the equity side. Sometimes it's a check. Sometimes you check off a box. Is there recourse debt on this property? There's some companies out there that focus on that, but it is something to be aware of and look into.
Yeah. Now Vance has a question here, and it kind of ties into what you were just saying almost perfectly. He says, "Are there any other non-recourse loans besides the Fannie Mae?" And he's got the question is like FHA. Like, what other non-recourse sources are there?
You've got conduit sources, which again, they are transactional lenders that they have warehouse lines of credit, and they package up your loan and fund them. Sell them to the secondary market as investment vehicles. Those are conduit lenders. FHA is a viable option for larger deals. FHA is not a lender themselves. FHA is just an insurance policy for another lender's loan, and it allows them to extend that debt based on specific guidelines. But again, it's just an insurance policy. Usually, you're going to want to see a larger loan amount for an FHA deal, at least a couple million, because they take a very long time to get done, and very long time, a minimum of 6 months. There's a lot of heavy lifting on the front end, so most lenders don't want to get involved unless it's a larger loan. And there's some initial expenses that are greater too. Your initial reserve requirements are much greater, usually about $1,000 a door. Your ongoing reserves are, typically north of $450, and you're going to have what is it? I know you have to have audited financials annually, so there's an added accounting expense there. You only distribute to your investors twice a year rather than quarterly, as it is with conduit and Fannie loans. So there's some variables in there where this specific deal really wouldn't be a fit for a 223, which is their acquisition and refinance program.
Okay. Interesting.
But I will say this: we're talking about loan sizes, and we're talking about IRA money. There are lenders out there that offer non-recourse loans below $1 million. I mean, they'll do a couple $100,000 deal. They really don't have a minimum loan amount, as long as 100% of the equity is raised from IRAs. So they only do self-directed IRA money.
Really?
Yeah, and they'll do small deals, but all the money has to come from IRAs.
That is amazing. I've never even heard that before.
Yeah, and they're not super high leverage. I mean, they're 65, 70% lenders.
Okay.
I mean, they're protecting themselves pretty good because there's not a lot of competition for those guys. They're kind of doing their own thing.
Yeah, I mean, one person comes up with a check that's not qualified money, and you're done. You can't do it.
Yeah, it's all got to be IRA money.
Wow, that's interesting. So, all right, Eric. Well, I'm going to have this deal into contract probably within the next few days, and then the due diligence process is going to start up, and I'm going to shoot this on over to you, and then we might have some other calls with you as we go through the process, just so that my mentorship students can hear how this whole thing is done, how the sausage gets made. All right, if anybody has any other questions, I posted your cell phone number to everybody on the call. So I think there are about 3,472 people on the call right now, Eric, so they've all got your cell phone number.
Excellent.
Yeah.
Unlimited incoming calls. I hope they're all.
No, and most of my mentorship students are from New Zealand, so you might be getting calls late at night. So,
I'm changing my plan.
Yeah, exactly. Yep. So, all right. So if anybody needs to get a hold of you, they've got your number. Thank you so much, Eric, for your time. This has been fantastic. Watch for our information. We're going to get it over to you as soon as it comes in, and then we'll just keep moving through the ranks and see what hoops we need to jump through to make this thing happen.
Sounds good. Sounds
cool.
I look forward to working with you.
All right. Thanks, pal. I'll talk to you soon.
Thanks.
All right.
Bye.
All right, everybody. I am going to hang up the call. Actually, I got to speak to somebody on the call right now. Somebody else. Let me just see if no. Okay. So I've got to get a little coaching time in with some of my students right now. I will encode this call so that I'll make it available to you. Just watch for it, and then if you have any questions, you'll see how it happens. Now, if you're in the mentorship group right now, going forward, you're going to watch this whole deal come together, whether it's going to be wholesaled, whether it's going to be sold, purchased directly, syndicated, or owner-operated, whatever it's going to take. You're going to watch this whole process go through the ringer, so to speak. So, and also, let me just, while I have everybody on the phone, coming up, as you know, Anaheim, March 28th, 29th, and 30th, another Shark Tank. I'm hopefully going to try to find another deal, like a 70-unit deal is what we're looking for right now. And then in April, the dates are on my calendar for the multifamilyinvestingacademy.com if you're in the mentorship group, there will be the mastermind program on Thursday and Friday before the weekend event, which is going to be the due diligence seminar. Due diligence boot camp. So that's coming up in April. Check my calendar on the multifamilyinvesting.com, multifamilyinvestingacademy.com website, and that'll tell you what that is. So if you're in the mentorship group, just shoot me an email and say you want to go to Anaheim, and I will register you offline, so you don't have to go through the credit card process. But other than that, folks, I hope this has been helpful, and we will chat with you all later. Have a great day.